Today, we're going to welcome in John Forney, who leads the U.S. insurance tax practice, to help us unpack the CARES Act and how that's going to impact our insurance carriers. So let's welcome in John.
Thanks, Matt, for the introduction. Yeah, the CARE Act has created some really interesting times. The focus of the CARE Act is around providing liquidity for these companies that are going through a really difficult time. That liquidity is really coming in three forms. The first being loans that the government's offering to these companies in order to help them through this difficult period. And I think the ones that we're seeing advertised or we hear about the most are clearly the airline and the hotel industries. In addition to that, the government is allowing companies to defer tax payments, and they're doing this for both direct taxes, effectively allowing them to file extensions and make payments. Instead of 4/15, they're waiting till 7/15. In addition to that, the government's allowing them to defer the payments associated with Social Security tax. It's the employer portion of that, 6.2. So they can defer that through 2020 and then make those payments half in 2021, half in 2022. The third piece of this is the one that I find the most interesting, and that's really the components of the CARE Act that are allowing companies to accelerate the monetization of deferred tax attributes. And, the ones that, from an insurance company perspective, that we're really going to focus on are going to be net operating losses, NOLs, and the enhanced ability to utilize them, and the monetization or acceleration of monetization for alternative minimum tax credits carry forward.
John, thank you so much for that overview. Now what I'd like to do is walk us through the CARES impact and how it relates to the lines of insurance. So if you're a property casualty, a life, or a health insurance carrier, what are the top 3 or 4 items that are going to impact them the most? So if we can, let's walk through those insurance line spotlights now.
Sure, Matt. Before I get into specifics of property and casualty and health insurance companies, I just wanted to make it clear that there are a lot of other components of the CARES Act that are industry agnostic, meaning that they would apply to insurance companies. But with that said, what we really want to do today is want to focus on those components that have more of an insurance industry taint. So in particular, net operating losses. So for property and casualty companies and health insurance companies, post-tax reform, the carryback and opportunities around NOLs really didn't change a whole lot. You still were able to carry back 2 years and carry forward for 20 and offsetting 100% of income. What the CARES Act did was it enhanced the carryback opportunity from 2 to 5. And this really provided an additional opportunity to create 3 benefits. The 3 benefits being, one, where we started from a liquidity perspective. You now have the ability to enhance the liquidity through the monetization of the tax benefit, the NOL, and do it more quickly instead of waiting to, get that benefit or carry forward. Now you've got 3 more years to go back to. In addition to that, one of the other key aspects of tax reform was the lowering of the tax rate. It went from 35% pre-tax reform to 21%. To the extent that I can carry that loss back out of a year that it was generated at a 21% to a carryback year that was taxed at 35%, I can capture that 14% rate differential benefit, which will be permanent. I won't have to, lose that. It's not a timing difference. And then the last piece of it is, to the extent that the NOL didn't meet the requirements of SSAP 101, so it effectively became a non-admitted asset. To the extent I can carry it back, it basically becomes a receivable, and now would be a good asset from a statutory capital perspective. So you'd get a statutory capital positive bounce, which clearly is a good thing. The other area that we're focusing on for insurance companies is around AMT credits. So again, part of tax reform was that when AMT tax went away, and to the extent you had unused credits, you were able to monetize them over a period of time. The CARES Act now enables you to monetize them on a quicker basis. You basically can either monetize them in 2019, basically turn them into capital, creating liquidity, or you could do it in 2018, filing an amended return and trying to accelerate it. So AMT, again, a liquidity perspective. The last component that the CARES Act provided to insurance companies, property and casualty and health insurance companies, is it enabled these companies to improve their NOL profile. And the way that they are doing that is by looking at some of the components that were benefits that are being provided. And those benefits are really focusing on the ability to accelerate expenses, to increase losses in a particular year. So hopefully you can carry it back into a 35% tax year versus right now, you would have had to go forward into a 21. And those are focusing on areas like qualified improvement property, which through a technical correction that came through the CARES Act, now are being afforded the same ability to accelerate as bonus depreciation. So I think that's a key component. In addition, other things that you'd want to be looked at would be the increased amount of charitable deductions that can be taken in a particular year, the improved threshold from a 163J perspective, the amount of interest expense that can be deducted in a particular year. All of these things would enable a company to increase losses or expenses in a particular year and hopefully generating an NOL that they then would be able to go back to, or at a minimum, to improve their tax profile in the current year by creating more expenses.
John, thanks so much for that detail. One thing I'd just like to go back to, and that's on the AMT credits. We know that those went away within tax reform, and the ability for corporations to be able to leverage those credits were spread out over years. Under the new CARES Act, correct me if I'm wrong, you have the ability to advance those credits into a prior year. John, can you just give us a little bit more detail into that specificity?
So what happened was AMT tax went away, and you used to be able to carry the AMT credit forward to offset that tax. Now, since the tax is gone, what the government was allowing you to do was to monetize those credits over a longer period of time. Now they're going to allow you to take all the credits either in 18 or 19, depending on whether or not you want to go back and file an amended return. But it's going to be an acceleration in the monetization.
John, excellent overview on the P&C and the health side. One thing I'd like to call out too, there were grants that were also built into the CARES Act that highlighted telemedicine. We know that the ability to get to doctors is now pivoting between the ability to go in person to now telemedicine technologies. So there are some specificities on the investment in telemedicine that healthcare payors will be able to benefit from. We're going to focus on that in another segment. So with no further ado, let's pivot into the life insurance business. John, let's walk through the insurance carriers and the impacts it's going to have on the life side.
Sure, Matt. So again, life insurance companies, similar to P&C and health insurance companies, are focusing on the area of net operating losses. Net operating losses for life insurance companies are a little bit different in that in tax reform, the ability to carry back NOLs, net operating losses, was taken away. In addition to that, the carry forward was limited to only being able to offset 80% of the taxable income. The CARES Act, by enhancing the carryback ability, similar to P&C and health, now puts life insurance companies in a position where it can take advantage of, again, three things. Those three things being, one, to enhance liquidity by carrying back and monetizing these tax attributes, the NOL. Two, taking advantage of the fact that tax reform changed the rate from 35% to 21%. So if I can carry back to a year with a 35% tax rate, I can capture that permanent benefit of the 14% rate differential. And again, from a statutory perspective, to the extent that the net operating loss was a non-admitted asset, to the extent it can be carried back, it now becomes a receivable, and it's going to provide a good regulatory bounce. The one thing a little bit different about life insurance companies is there were a set of rules, the old what they call bumping rules, and those bumping rules somewhat limited the ability of companies to offset non-life income with life losses. So that analysis will need to be done. It's consistent with what the law was prior to tax reform. And I think the last piece that I did want to bring up, and probably should have brought it up in the P&C and health piece, is that you're also going to have to consider, to the extent the company has a global footprint, are there any impact to any of the new international tax regimes that have been put in place, predominantly GILTI? In addition to NOLs, alternative minimum tax, like in the P&C and health area, are also going to be an opportunity where they're going to be able to monetize them quicker, again, focusing on liquidity and turning those unused alternative minimum tax credits into capital. The last piece, again, consistent, is that the CARES Act will enable life insurance companies to improve its NOL profile by enabling them to accelerate expenses into a year that will provide them with the most beneficial carryback profile. And in the process of doing this, one other thing is that there needs to be a more focused approach around life reserves. There's new regulatory rules that came up, and it's going to be key to make sure that you're adhering to them as you go through the tax year.
John, thanks so much for the overview for P&C, health, and life. I think it was phenomenal. Now, what I'm asking myself is, how do I take all of the details that you just gave and unpack them for my business? And from what I understand is your team has created a 5-step process to be able to understand this by line of insurance. Can you walk us through that?
Thanks, Matt. Yeah. So again, the process is that we've created a GT CARES Act diagnostic tool. That tool will be pushed out to clients who will then fill in this survey. The survey will focus on a lot of what we've been talking about in this video. That then will be used to basically create a profile. That profile will then be used to come up with a workshop. And in the workshop, there'll be scenario planning and modeling that will lead to us collectively focusing on what areas make the most sense. And at that point, from an execution perspective, we'd be there to assist the client in filing amended returns, carryback claims, whatever was required in order to obtain this benefit.
John, thanks so much for that overview. And I know me personally, the diagnostic tool makes a lot of sense. It takes all of the research and the detail that your team has done for each of the three lines of insurance and applies it into a practical solution. So I'm sure our teams and our clients and our carriers out in the market will also appreciate that. I'd also like to thank you and your team for joining us. We will, I'm sure, see you again. Thank you, everyone. Stay healthy and safe, and we'll talk to you soon.